Hello, and welcome to this webinar on understanding business risk management with me, Rajan Sharma. I'm an analyst here at Turnkey Consulting, where we help customers with all aspects of business risk, from the processes to technical implementations, including governance risk and compliance, identity and access management, cybersecurity, and application security across the enterprise. So, in this session, we'll be looking at what we mean by a risk in this context, how you might go about establishing the risks related to your business, the process behind performing an assessment of those risks in line with your business's risk appetite, how you might go about mitigating or controlling these risks, and also approaches to risk reporting. We'll then finish off with a quick summary of the content covered. So, before we aim to understand business risk management, we need to first get to grips with what we mean by a risk, and this isn't always as straightforward as you might think. The word risk can be used in many different contexts and therefore with many different meanings. However, when we're talking about risk in business risk management, it generally refers to the probability or likelihood of an event occurring, which is usually unwanted or negative. Now, this differs from a threat, which refers to the potential harm, i.e. what could actually happen to whatever you're trying to protect, i.e. the asset. You'll find that these two terms are often confused and used interchangeably in the security industry, and so I'd just like to distinguish them early on. In addition, it's also important we understand what the vulnerabilities are of an asset or resource, and this essentially refers to its known weaknesses which make it susceptible to a threat. By having a good understanding of the threat and vulnerabilities related to an asset, it will give you a better understanding of the risks associated with it. Having established what a risk is, we now have to look at it within the context of business risk management. Of course, different businesses will have different risks. For example, cybersecurity risks or risks relating to intellectual property rights. Think of those companies whose unique selling point is driven by a specific recipe used in their products, which help them stand out from their competitors. These risks often relate back to a business's strategic objectives, and so the process of risk management helps you to identify and address these risks, putting you in a position to achieve those business objectives. Often a risk can be quantified, making it easier to be assessed and managed by risk professionals. To do this, we assign values in relation to the probability of the risk or event occurring, and multiplying that by the financial value of its effects, as shown by the formula. This is something we'll look at in a little bit more detail later on in the presentation, particularly as it forms a key part of the risk assessment process. So just to reiterate, and I guess put it simply, threat is the potential harm to an asset. Risk is the likelihood of this harm being realized, and vulnerability is a weakness which the threat can exploit. So, what are your business's risks? Well, the next step is establishing those and getting a clearer picture of your business risk landscape. As mentioned earlier, many of the risks you'll identify will be driven by your business's strategic objectives. Therefore, capturing as many of the risks your business could face as possible will allow for the risk management process to be most effective. This includes those risks which don't directly impact or relate to your business, but could have the potential to. Take, for example, natural disasters, which could destroy supply chains. We also need to take into account those risks specific to the industry your business sits within, as well as those risks related to the business itself. In terms of risks relating to the industry, these are likely to have some level of impact on all of the businesses within it. However, it could be argued that those businesses which cover a large market share within their industry, take for example monopolistic or oligopolistic industries, are likely to be exposed to greater threats. Let's take for example the manufacturing industry. Organizations within it could be exposed to environmental laws and regulations, fluctuations in FX and interest rates, changes in global supply of materials or fuel, or even risks driven by legal restrictions. In terms of business-specific risks, these have more to do with how the business operates. So let's take, for example, a global manufacturer within the manufacturing industry. Business-specific risks might include a dependency on specific industries or suppliers, risks relating to information security, so for example, the way that IT is set up, or intellectual property rights, as I mentioned earlier. Now, having established your business's risks, you then need to assess them, i.e., how serious is this risk, and how does it compare to the other risks? Therefore, assessing your risks effectively will help you to subcategorize them into those which have a high, medium, or low level in relation to your business. This assessment can then be used to inform appropriate risk responses and controls to ensure these risks are managed effectively. So as I mentioned before, you can quantify your risks, giving them a risk score. As you can see from the formula, you've got the probability or likelihood of the risk occurring multiplied by its impact, and this is usually driven by the financial impact it could have. And this will give you your inherent risk score, or in other words, the risk score in your business's worst case scenario. Often you would find a value such as a percentage or an arbitrary score in relation to the probability and impact in this case, which would be driven by the business's own internal analysis. For the impact, this could even be the value at risk, so for example a financial figure, or be based on a 3-point analysis, such as best case, average case, or worst case. Then, through the application of appropriate risk responses and controls to your business, you can bring this risk score down, giving it a residual risk score. So as you can see from the diagram on the right, by responding positively to this risk, it will hopefully put the business in a better position to achieve its objectives. Now, every business is different, so their risk appetite for risk is also likely to differ. By this, we mean the business's evaluation of its trade-off between risk and return. Depending on the company's risk appetite, they may choose to accept, reject, or reduce a risk, and there is software out there, such as SAP Risk Management, which can aid businesses in the risk assessment process. Okay, so now we'll look at how we can potentially mitigate or reduce the risks facing your business. These risk responses could help to protect your business's cash flow, operations, or reputation. But ultimately, the goal is to drive the success of your business so that it can reach its objectives. This process might start with engaging with risk owners within your organization to understand what controls are already in place to reduce these risks. And then on top of this, you'd be looking at structuring your resource allocation in line with your risk assessment to ensure the right level of controls are being utilized and implemented to help mitigate those risks the business faces effectively. And here you can see from the diagram a few ways this could be done. Take, for example, appropriate capital buffers to absorb losses and react to economic shocks. This might be a particularly important risk response for those businesses in the banking industry. They tend to be heavily regulated as a direct impact of the financial crisis in 2008. So therefore, holding the correct level of capital is an important risk response to cope with economic shocks and therefore ensure that the economy doesn't go into downturn. You've also got insurance products to help protect against financial loss, access process and inherent application controls, which will be particularly useful for those businesses that utilize an ERP software, for example, like SAP. You've also got strong governance and compliance as a risk response. So, for example, keeping up to date with the latest changes in regulation, and also diversification. So that could be with regards to investments or the suppliers you choose. Finally, we look at risk reporting. Getting risk reporting right is important because it's a way of communicating your business's risks to the people who need to know, and that's both within and outside of your organization. In some cases, the people who monitor and manage the risks in your organization, i.e. the risk owners, will be responsible for producing these reports. Accurate risk reporting can therefore be useful to investors and other key stakeholders, resulting in better stewardship and also efficient allocation of resources. With that being said, there are many ways you can report risk in your business, and choosing the most appropriate way which truly reflects the risk profile of your business is the key here. Reporting on a business level takes into account each business unit and their related risks, which can be exceptionally useful in the business risk management process. It's therefore also important to note that information flowing up and down the risk reporting hierarchy should be consistent, because this will ensure the report is as accurate as it can be and most reflective of the business. Which I guess brings me on nicely to the potential challenges surrounding risk reporting. This could include the accuracy of what's included. That will always be a point of discussion, as it relies on all the information being truthful, and that the consistency element, so that the full picture of a business's risks are captured. Also, there are associated costs in producing the report, which could limit the quality of the information, and the quality or experience of the firm's risk managers could lead to some risks being understated, whether that's intentionally or unintentionally. So, some key points to take away. Correct identification of your business's risks is crucial to risk management. Having a clear understanding of your business's risk appetite and assessing your risks accordingly will help to mitigate them. Choosing an appropriate risk reporting method will help you get the right information to the right people and inform your own risk management strategy. And the risks facing your business are continually changing. Business risk management should be an ongoing process within every organization and should form a big part of its strategic management. If you would like to find out a bit more or how Turnkey could help you or your business, you can get in touch with us via our website, where you can access a variety of resources, including blogs and ebooks. Or alternatively, if you do have any questions, you can get in touch with myself via the number or email shown. Thanks for listening.